Hello. In this session of security analysis and portfolio management, we are going to discuss about the organization and function of equity and debt market. So, before we move on the particulars of the equity or debt market, let us spend little time on what is securities market as such. Securities market is a place where the financial instruments are traded. When you say financial instruments, it could be shares of the company, it could be bonds, it could be debentures, it could be treasury bills of the issued by Government of India. Any financial instruments issued by any issuer for that matter, where the trading takes place, that is called a securities market. Essentially, it is a meeting place for the buyer and seller of financial instruments. Now, securities market need not be comprising of only the instruments. It can comprise of people, the institutions, the issuing organizations like company, government, state government or central government, then any banks or financial institutions who are actually the issuers. It also comprises of the system that facilitates these particular transactions taking place between buyer and seller. It also comprises of regulatory authorities like Securities and Exchange Board of India, SEBI in case of India, or Securities and Exchange Commission in case of US. It also consists of Department of Company Affairs in case of Government of India. It also consists of other regulatory agencies like Reserve Bank of India. Whoever is also going to oversee the affairs of the market, their players and process, that is also comprised, that also part of securities market. In fact, the stock exchange that is popularly known as where the trading happens, that is also part of securities market. So, it comprises of the entire people who trade, institutions who trade, institutions who issue, government, company, regulators, all those things who are involved in the transactions involving financial securities are part of securities market. Then coming to the classification, the securities market can be classified in broadly two ways. One is that on the basis of tenure of the instruments that is issued, that is one is a long term capital market, long term market or a short term market. When you say long term, when the company has or the issuer has raised the finance from the savers or the investors, it does not have the intention of giving it back to the investor immediately. Typically, more than 3 to or 5 years can be taken as long term instruments, and the long term instruments is when it is issued, that particular market is known as capital market. The long term instruments can be both ownership forms like shares, or it can be of lender form, that is debts, debentures, bonds, or hybrid form like preference shares for that matter. Then if any instrument is issued for a short term period, or the market deals with a short term instruments like treasury bill of the government of a particular country, then you have got certain instruments like commercial papers issued by the corporates for short term funds, which is typically the tenure could be some 81 days, 89 days or 181 days, or maybe less than 365 days. So, those particular market is known as money market instruments. So, money market is essentially short term, and the capital market is essentially long term. Then the next classification that we have is it based on the transactions in the market, how the transaction takes place. If the first time the transaction is taking place between the issuer and like the company is issuing a shares to the public at large through a particular process to the potential investors, that is called the primary market. That means this is the first transaction taking place between the issuer and the investor. Post issue, if somebody has already entered the particular investment, particular share or particular bond or particular debenture, and he or she like to exit from that particular instrument, then he or she has to go to a search for a person who is willing to buy that particular instruments for a particular price. So, it is may not be possible or feasible for a particular investor to get the best deal by just going and standing in somewhere and in the market and expecting that somebody is going to buy his share or debenture that he has purchased from earlier through a primary market. So, in such case there is a platform which is provided by the system or the market in the country, that where the seller of the instrument who has already bought the share earlier would like to look for a particular buyer. So, that particular market when the transaction takes place between a holder of the instrument and he or she sells his instruments to somebody else. So, that is called the secondary market. So, what happens? So, any transactions after the primary issue market has taken place, any transaction involving that particular instrument is not now secondary market transaction. It may change from one hand to multiple hands subsequently, but that still remain as securities secondary market. So, in fact, besides that, somebody who has already bought the shares or debentures in a particular instrument, he can exit from that. At the same time, some other investors may be there who could not for some reason participate in the issue of that particular shares or debentures when it was offered to the public, but later they realize this particular share or debenture is worth investing. So, they will look for to invest again, but the company may not come with another issue of this particular instrument for that matter. So, in such case, if somebody is willing to sell the instrument, then the other person who is willing to buy can also buy from this. So, these transactions between holder of the instrument and potential buyer of the instruments is known as the secondary market, where there is a seller as well as buyer of the particular financial instruments. Beside this long term like capital market and money market instruments like product wise, there can be also some other instruments which are risk hedging instruments, like we have futures, options and derivative securities, where the value of this particular instruments like options or futures or whatever, that interest in that, all those things is derived out of the underlying assets. So, that they also come under the securities market, but they are the essentially instruments for risk hedging, for which we have a separate session and we will be discussing more about that those instruments then. Then coming to the next category, that is our broad market or capital market. In this particular session, we will be devoting more on the capital market and which comprises equity as well as debt, and also we will talk about certain things about primary market as well as secondary market. So, when we say capital market is essentially related to long term finance, and the instrument that is a part of the long term finance or capital market can be shares, can be debt instruments, or can be and those instruments can also be in physical format or the demat format or digital format for that matter. When you say shares, it is nothing but an ownership of a particular company, participating in ownership of the particular company, and the shares can be of two types. One is equity share, another is preference share. In equity share is essentially the ownership of the company. So, if I have got one share out of 100 shares issued by the particular company, then I can say I have 1% stake in this particular company. And equity share, as we have discussed earlier in the overall financial markets. So, in this equity share, they are owners, and the equity shareholders become the residual stakeholder of the particular business. That means, after all the stakes of all the stakeholders taken care, whatever left over, that belongs to the equity shareholders. And these equity shareholders typically usually they have a certain voting rights. So, they can participate in the decision making through giving their vote, and if the company calls for an annual general body meeting or any general body meeting, the equity shareholders can come, and depending upon the number of shares held, their voting right is going to be determined. So, if I have got one share, I have got one voting right. If someone has got two shares, he or she has got two voting rights. So, that is called generally the voting equity shares with voting given, so ordinary shares. But now of late there are some other instruments which have come, that is called non-voting shares. So, non-voting shares, what happens, though they are like equity shares, but they do not have any participation in the meetings or the decision making as such. So, they do not have any right to vote for or vote against any decision making of the organization as such in the general body meeting or whatever shareholders meeting take place. So, what makes this particular instrument more attractive? Usually the non-voting shares get a differential return, that is a better return than the equity shareholders. Equity shares are supposed to be getting, though it is not compulsory, something a return known as dividend. So, if the equity shareholder is getting some dividends, and non-voting shareholders will be getting something more than the ordinary equity shareholders. So, since they have divested with the dispense with the voting right, so to take care of that, higher dividends are declared. So, this could be attractive for certain shareholders who do not want to take part in decision making process. They are rather content with the dividends on the investors on the shares. So, that may be attractive for those people. There are also some other type of share, that they are also known as class B or class B1, like that, the shares in other market, but in Indian context we talk about that is differential voting rights share. So, in what happens in this case, in this type of share, the shareholder of the differential voting rights share will have a different voting right, that means more or less than that ordinary shareholders. So, one may have one differential voting rights share, this particular type of share, then but he may have two voting rights for one share. So, this is typically issued to the promoting shareholders, so that they have more control, and these differential voting rights they may be able to exercise that, or it may be of help when the particular company becomes a target of a particular acquisition market. So, if somebody is going to acquire, so in this case this particular voting rights may be revoked, and in that case invoked, and in that case the differential voting rights shareholders will have more votes, and they may thwart any takeover that is going to happen for that matter. So, that is called differential voting rights shares. Then preference shares. Preference share is that they get certain preference over the equity shares with regard to dividend and the principal repayment. So, the company wish to declare dividend on the shares to the equity shareholders, it has to first declare the dividend to the preference shares, and preference share will always have a nomenclature of some like 5%, 10%, a certain percentage as a prefix, and such percentage known as the dividend that is expected to be declared on the preference. As if it is a 12% preference share of rupees 100 each, that means at the end of the year the preference shareholder will get 12 rupees dividend. After having declared the dividend for the preference shareholder, then only the dividend for the equity shareholders can be given. That is one preference, that is over dividend. Second preference that preference shareholders get, let us say the company has to wind up and it will give the money back to the stakeholders, the first preference will be given to the preference shareholders. Of course, before that all the creditors must have been taken care, all those outside obligations must have been taken care, except the claims of preference shareholders and the equity shareholders. When it comes to the satisfaction of claims of shareholders, then the preference shareholders are given the first preference, and then the equity shareholders are given the next preference. Then we have debt instruments, that is called bonds or debentures. These particular instruments are nothing but a loan which has been split into small parts. Let us say the 1 crore rupees of loan can be distributed, can be split into 1 lakh parts. In that case, we have got 100 rupees each, and that one bond can be of 100 rupees each. Usually the bonds are having a face value of 1000 rupees, whereas in case of equity shares and all, we can have face value up to 1 rupee per share. So, the bonds and debentures will be getting, the bonds and debenture holders will be getting a periodic payment called interest, and they will also get back their principal amount at a certain period of time, and the principal also can be given in installment. So, need not be given only at the end, it can be also given at the in between of the tenure of the instruments. Then we have another category, those all these instruments that we talked about can be classified into physical versus dematerialized. When you say physical instruments, that means there is a proof in terms of a like a paper based instrument, where one gets certificate that says that this particular holder of this particular instrument has this many shares with him, and whereas in a demat format, this physical physical instrument is not in existence, rather everything is in a digital format, dematerialized format. So, there are two major agencies like National Securities Depository Limited and Central Depository Service Limited in India, which are the depository institutions which has got the dematerialized instruments of different instruments issued by different companies, which are earlier in physical format or even newly issued, now they are in digital format. So, they are the depository of these instruments, and these particular organizations have participants like depository participants, and for any investor to trade in the stock market should have an account with the depository participant, and like we have an account with the bank for the savings deposit or whatever deposit for that matter, and it gets debited or credited depending upon whether we withdraw money or we deposit money. Similarly, this demat account kept by these depository participants and held by the investors will also show that how many shares of which particular company is there in this particular investors name. so that there is an account of which shares are there, which are not there, and the shares trading takes place. Let us say the investor will buy certain instruments, then it will be created, that will be having that more, yes, that will show that yes, this particular investor has got now new shares of this particular number. Similarly, the shares are traded and sold by this particular investor, then that account will show that how many shares are now there after this particular sales has taken place. Then we have also a process of rematerialization. There is also process if the investor wants certain subject certain rules and regulation, he or she can convert the dematerialized share into physical format. So, it will be now the investors will be issued certain physical instruments like in terms of paper, black and white, it will be issued there. So, dematerialized is there as well as rematerialization also possible when dematerialization already taken place. Next we move on to something called the broad market of equity market. Equity market, as we discussed, it is comprises of equity share and trading in that particular equity share. Equity shares can have whenever the equity shares are issued by the company, it can be issued at a face value. Face value is something like on the face of the instrument. Yes, it can be rupees 10 or it can be rupees 5 or rupees 1, that is the face value, but this particular share can be issued at a price more than the face value or at a less than the face value. When the share is issued at a price more than the face value, it is called shares are issued at a premium, and the shares are issued at a value less than the face value, that is called the shares are issued at a discount. Of course, whether the company can issue these shares at a premium or a discount, there are certain regulations given by the Companies Act, as well as there are regulations given by the Securities and Exchange Board of India, SEBI, in the context. It is not that anybody can, though it is now it is free for the company charge whatever price they would like to charge for their share, but there are certain conditions that must be fulfilled before the company got a permission to go for any pricing of the share for that matter. Then there are certain shares which are also looks like they are issued for free, they are called the bonus shares. Or and bonus shares means what happens, the company has raised certain amount from the market through issue of equity shares, and let us say the company has raised rupees 100 crore and thereof rupee 5 is, so in that case there are 20 lakh shares or 2 million shares issued. Now, after certain point of time, this amount gets invested, then the reinvestment takes place. Let us the company has accumulated certain reserves and surplus, that is accumulated the profit after certain point of time to the extent of rupees 300 crore. Now, at this point of time, the company can think of declaring or converting this reserve surplus, because this anyway belong to the equity shareholders, into equity share. So, the company may think that for every share that they have 20 lakh shares here of rupees 5 is, they like to sell, they like to issue one for each one held by a particular. So, 1:1 bonus. So, what happens in that case, out of 300 crore, 100 crore goes towards share capital and the reserve surplus now becomes 200 crore. So, new equity capital will be, equity capital is now 100 plus 100, that is 200, and reserves and surplus, that is now another 200, total comes to 400. So, overall stake of the investor has not, equity holder has not changed. Earlier it was 300 plus 100, that was also 400, now it is 200 plus 200 is 400, but instead of one share, the investor has another one share. So, any person who is having one share is now have two shares together. So, this is they giving you one share for bonus, but in any case if the shares are traded at that point of time before the issue of the bonus, let us say the market price of the share is rupees 30, then once the bonus is issued, the share price, market price will correct itself to half of that, because now 30 is worth for now 2 shares. So, this will correct to rupees 15. So, effect in the market there is no change, that yes, the number of shares might have gone up, but the overall stake of the particular overall market value of the particular share has actually remained constant. Of course, is another matter that the market may take this particular issue of bonus as a different signal, good signal, bad signal, and accordingly the share price can move up or move down, but first it will correct from rupees 30 to rupees 15. Then there is something called stock split. What happens in stock split? This instead of issuing bonus shares, to have more liquidity in the market, the like in this example, this company may think of splitting the shares of rupees 5 each into rupee 1 each. That means, instead of 1 share, the investor will have now 5 shares of rupee 1 each as face value. So, it will be, if the company was having earlier 20 lakh shares, now it will have 100 lakh shares or 1 crore shares that is issued to different investors in the markets. That is supposed to be leading to a more transactions in the market, because number of shares are more, though the value is less. Now, the price will also automatically correct to 1/5 of the original price when there is only rupees 5 as the face value as such. And if 30 rupees was the share before the stock split, the price will now become 30 by 5, let us 6 rupees per share. Now, instead of having 1 share of 30 rupees, now one has 5 shares rupees 60, that becomes now rupees 30 in terms of market price. So, overall the investor does not gain just because the stock split or the bonus issue has taken place. Then coming to equity market, the equity market in the shares can be issued to the general public through something called initial public offer. Initial public offer means it is the first time this is offered to the public at large, where general public as well as the institutional investors can participate. And if the that is the first time, it is not that the first time the shares have been issued, shares might have been issued to the promoters earlier, but to the public it has been issued, and the particular offer document has to be filed with the Securities and Exchange Board of India, and this offer document has to be vetted by SEBI, not indicating that this particular whatever has been declared is good or bad. SEBI ensures that whatever material information is should be there for the investor to take a decision to buy or not in this particular share, and those information have to be disclosed by in the offer document. And once the offer documents have been vetted by the SEBI, the company can issue it to general public, and any such public offering that comes after the IPO has taken place, that is called the follow on public offer APO. So, there is, as far as the nature of this particular process is concerned, there is no difference between these two, but only thing is that the follow on public offer is that it is more than once the company has come with the public offer. The first time it comes is called initial public offer. So, the company in its life can only have one initial public offer and can have many follow on public offer. Then there is one more process where it is called rights issue, and it need not be it can just be informed to the registrar of the companies in a particular state, where the company is registered, that the company is going for rights issue. It need not be approved by SEBI for that matter. What happens rights issue? The existing shareholders have got a certain right called preemptive right over any new shares are issued, so that they will not like their ownership to be diluted by having shares with other investors outside, who are those investors who are not the shareholders at present. So, the when the right share comes, the existing shareholders are given the right to buy the share of the particular company for a particular price. Now, obviously, if the price of the share at where the particular share is going to be issued is going to be less than the market price prevailing, then it will be attractive proposition for the shareholder to buy the rights to get the share. Then and another thing is that the rights themselves, that I have a right to buy certain shares of this company at a particular price, can itself be sold in the market to someone. So, that instead of I myself exercising the right, someone else exercise the right. So, let us say the price of the particular share prevailing is 100 rupees, and the rights issue price is 90 rupees. That means, if I subscribe this particular share for 90 rupees, I can sell in the market for 100. So, I get a gain of 10 rupees. So, instead of subscribing the rights, I can rather sell the right to someone for certain less than 10 rupees or 5 or 6 rupees for that matter. Then I have a gain of 5 to 6 rupees. Let us say 5 rupees I sell the share. So, I get 5 rupees, and the person who is buying the right, he can buy the share at 90. So, 90, and he has paid the 5 rupees as the rights price to me. So, he is spending 95 rupees for getting a share worth 100 rupees, that is in the market. So, he is gaining having gain of 5 rupees. So, unless the market price is more than the rights price, the rights have no value for that matter. Then we have another transaction that takes place in the equity market is called buyback of shares. So, usually or all it is that it is not mentioned in when the equity shares issued by the company that when this particular shares is going to be taken back and the money will be given. Equity shares are supposed to be the perpetual instruments of the company. If the investor would like to exit from the equity share holding, he or she can sell the share to another person in the secondary market, but company is not obliged to buy the share from the investor. But depending upon certain regulations provision that is been taken care by the company can think of buying the shares from the market by going for an offer in the market. It says that it intends to buy the shares from the existing shareholders at a particular price. So, subject to certain regulations of the regulators, the company can buy back the shares. So, that is called the buyback of shares. What happens essentially, the company is giving back certain cash to the equity shareholders, and it is optional for the equity shareholder to sell the shares or not to the company. So, with that what happened, the number of shares of the company gets reduced, and company possibly intends to enhance the parameters of the financial market performance, like earnings per share or something like. When the number of shares gets reduced and earnings per share is likely to go up. So, because of that possibly the company may think of buying back the shares. Then next we move on to the public offering different terms, and that is certain terms that is there. When you talk about something like primary market, we have something called issuer. Issuer is the party or the institution or the company organization which issues the instruments to the public at large. So, that is the issuer, like company, let us say Infosys comes with a public issue, or recently certain public sector undertakings have come with public issue. So, they are called the issuer of the instrument, and all this issue when it is going to be offered to the public at large, there may not be the competency in the company for that matter to handle everything, and there are so many regulatory aspects to be taken care, so many rules and procedures have to followed. So, there will be professionals who help in this particular process, and we have certain professionals like professional institutions like investment bankers. For example, we have got something like State Bank of India or SBI Capital Market. There are several such ICICI Securities, like there are several organizations are the DSP Merrill Lynch. So many organizations are there which facilitate this particular process. We have international players like Nomura for that matter in India. So, they facilitate this particular process, they help the company go for a public offer, and they have the expertise to look at whether all the things have been taken care, that all proper due diligence has been taken care or not, all the rules have been followed or not, whether the prospectus or the offer document filed with SEBI is confirming all the rules and regulations. All those things are nitty-gritties, legal issues, procedural issues are taken care by the investment bankers. So, they are actually facilitators for the public issue. So, they are also very major players in the market, and investment banker also have to be registered with this Securities and Exchange SEBI for that matter. No, without registration these investment bankers cannot play a role of investment banking. They have other services to do, but such type of activities can be done only when they are recognized by the SEBI as investment banker. Then investment banker can be have two types. One is a lead manager who facilitates the entire process. There is another one is called another type of investment banker is called underwriter. Underwriter is something like a insurance coverage, something like that. So, what happens, let that the company is coming with a public offer, and for some reason this particular instrument or the shares or something like that is not appealing to the investor. So, there may not be 100% subscription for this particular instrument. So, in such case the underwriter gives an undertaking that yes, for a fee which that is been promised to them, irrespective of whether that is invoked or not, and they will be getting the fee that yes, if the company fails to getting the full subscription from the market, then underwriter is going to buy the shares or the instruments from that. So, they give a comfort level for the company. Yes, if there is any problem, the underwriters are there to buy, and there are certain regulations for underwriting also, which we are not discussing in detail here, but there are certain regulations prescribed by the SEBI in Indian context. Then you have registered to the issue. Registered to the issue is like that, who will maintain to the who are the potential for the applicants, then who register also maintain the records of share owners of the who are the persons who own this instrument, who own the shares, Then the transfer takes by the registrar, which also can be known as transfer agent. If somebody will like to sell the share, then the share has to be transferred another person name. So, they will take care of that particular record. So, they will have a register of the instrument holders, maybe shareholders, maybe debenture holders, or maybe bond holders. So, they have all the information about who are the buyers of this particular instrument. Then there are certain another organization like bankers. So, it is not that the company is going to get this money from the investor directly, rather it will be through a banker. So, the banker will have the funds for certain period of time, where the depositors actually apply for these shares through a particular application document, and the banker will be collecting the cash on behalf of the company, and it will be passed on the company at the right point of time. Then there are certain brokers who actually ensures or they facilitate spreading of this particular information, that yes, this particular shares are issued. Beside the public advertisement that takes place through electronic media or print media, brokers also they also circulate the application forms across the banks or the stock exchanges, or wherever there is a possibility that the investors can come and look at that. So, they facilitate us. Brokers need not be mandatory for the company when going for public issue, but it is always better that, because they are in touch with the investors and the ground level and the grassroots level for that matter. So, it is the company may take the help of the brokers, and the brokers are actually the members of stock exchange, and each broker can also have their sub brokers who participate. And obviously, this when you go for an application of a document, and there is a broker code there. So, there will be certain commission percentage that accrue to the broker, because for him this particular share application might have actually come. So, they are there to spread the message and also facilitate the process for that matter. So, these are brokers. Then we have other terms and in the public offering, there is called prospectus. This prospectus or the offer document, it covers all the relevant information to the public, the issue and the company, so that the investor can take an informed make an informed decision. So, as we have discussed earlier, the investment banker will facilitate that every information is given, all the rules and regulations complied with, and the offer document is given to SEBI for vetting, and that offer document is supposed to be taking care of all the things, what the company is going to do with this particular issue of money, issue of shares, where the company raises funds, where these funds are going to be applied, what are the company's future plan, what are the risks involved in this particular business, where are the product market, all those things have to be, the regulatory approvals have been taken or not, or this company is going to listed or not, where is going to be listed, all those things, entire detailed things are available in that offer document, which helps the investor to make a decision, yes, I will buy or not buy this particular share. And this prospectus can be of something like red herring prospectus. Red herring prospectus is something which is not final. That means, what happens because of the recent phenomena, the company, when they files the prospectus of the SEBI, in that case there are certain things, particularly with respect to number of shares and the price of the share may not be finalized. So, there are certain things which are not finalized, but other things are more or less there. So, that is given to that is submitted to SEBI for vetting, and that is called red herring prospectus. Once all the informations are there with the company, then a final prospectus is given to SEBI for information. Then there is something called shelf prospectus. A shelf prospectus is useful for those company, and it is allowed for banking and financial institution in Indian context, where instead of going for repeated number of filing of prospectus, a shelf prospectus is kept with the SEBI or the regulatory authority, and for now it is for public consumption also. So, the company can come with multiple number of particular issue in a particular given period of time, let us say 1 year, and every time the company comes the new issue, the company only has to give an information memorandum, some additional information to be provided to the in addition to the original offer document or the shelf prospectus, it will be giving certain information memoranda, which will give more information which is now vital for the decision making. So, company need not file the full prospectus every time it goes for that. So, it is kept in the shelf, which is on for a particular period of time. Every time the company comes with a new issue, in that particular time it will only come with another information memoranda. Then the shares or the particular shares for that matter can be priced fixed or can have a price band. So, the company may think of, depending on the particular valuation of the particular share, the company may think that okay, we will issue the shares for rupees, this is face value of a share, let us say is rupees 10, and depending on the valuation of the share, the company thinks that it can be priced at rupees 40, that means this is rupees 30 premium. And once this particular price is fixed, it is offered to the public. It may be possible that all the shares are not subscribed, or there is a very less subscription, because company always feel that there is a lot of demand for its shares. It talks about the reputation in the market, the goodwill of the market, goodwill of the company, or the reputation of the company in the market. So, company will always like that the shares are subscribed, rather it is oversubscribed. That means there are more applicants, number of shares applied compared to the number of shares available for the investors. So, for that, when there will be less number of application, when the shares are perceived to be value high, and when there will be more applications, shares are perceived to be valued less. So, there is an undervaluation problem, then there will be more applicants for that. So, at that point of time when that happens, the company may feel bad or feel good or feel bad that it could have priced more, because there is a lot of subscription for that, and there is a risk also involved that yes, there will not be enough subscription, it may devolve on the underwriters because there is under subscription for the instrument. Then in that case there is a also talks of reputation. Instead of doing 30 rupees as the premium, the company can think of that yes, the share is within a band, let us say it is between 35 to 45, and there are certain principles that like that this lower band will be maximum 20% less than the upper band, there is a difference like that, and so let us say 35 to 45 is there. So, now what will happen, this will be the offer that the shares will be issued anything between 35 and 45. So, the investors will now offer to buy the shares at a particular price between 35 and 45. So, based on the response the company is going to finalize, and this particular process is also known as book building process, which you have in the next point, which is book building. There is a book runner which actually maintains the book of applicants of the shares, where the shares are applied for by the investors at different prices, and these prices are arranged in a particular manner like ascending or descending order. So, obviously, the company is going to issue the shares at the best possible by the highest possible price, but let us say in this example, let us say their company will like to issue 100 shares. So, let us say there are only 30 applicants who will like to buy at rupees 45 per share. That means, there are 70 more applicants have to be there, there may be another 40 who will like to buy at rupees 42, there may be another 20 who will like to buy at rupees 41, and then there are another 30 who will like to buy the share at rupees 40, then there may be rupees another let us say 20 share applicants, 20 application 20 number of shares who will like to buy at let us say rupees 38. So, there are let us say these are the 5 prices have come out from this application. Now, you can see here. So, if you go for a cumulative number of shares applied 30, 40, there is becomes 70, then it becomes 90, then it becomes 120. That means, the shares are subscribed to the extent of 100% within by the amount of the minimum price that company is going to charge is rupees 40, not beyond less than 40 as such. So, that will be the price, and because the Dodge auction what happens, it is done like this, but all the shareholders whether you have applied at 45, 42 or 41, everybody will be given at rupees 40 as per the. So, this is the lowest, this is price, because at that point all the shares subscribed. Now, one can see here that there is 120 applications for 100 shares. Now, this when there is more number of applicants for compared to the more number of application of for shares compared to the shares that is they are offers sale by the company, in that case there will pro rata arrangement has to be there. That means, for in a very simple ratio, for every 1.2 share applied for, 1 share is going to be issued by the company. Then the company can also have something like green shoe option. Green shoe option means that in case of oversubscription to the number of shares, the company can retain the oversubscription amount to the extent maximum possible to the extent of 15%. That means, if the company has offered to issue 100 shares and there is application to the extent of 120 shares, then company can exercise the green shoe option and go up to 115 shares to be issued, and obviously to 120 applications on a pro rata basis. So, it is a combination of green shoe option as well as pro rata allotment. There is a new thing that has come in Indian context, that is ASBA, that is application supported by blocked amounts in application for shares in IPOs and NPOs. So, what happens in this case, when the shareholder is the potential investor is applying for the shares in the market, in that case what will happen, the amount that is there with in the bank for this particular investor gets it is there and it is getting transferred to the it is never with the investor now, with the investor cannot utilize that, but the ultimately the shareholder may not get the shares, because all the shareholders may not, all the applicants may not get the shares. In that case, the shareholder is, the applicant is going to get back the money, but this money has already been blocked and it has been taken from the account, and the investor loses the interest. Instead of that, is losing the interest, there is what happens, this particular amount will be blocked by the banker, but it will be still with the account holder, and only when the shares are actually issued to the, and the person is becomes eligible for the shares, then only the amount will be transferred to the company. So, the investor will not lose the interest on the amount if the company fails to, or company cannot give the shares to the, issue the shares to the particular investor. So, that is a good provision that has come in Indian market. Now, we move on to the secondary market, where we talk about something called a stock exchange. The stock exchange is in a place where the buying and selling of the shares and other financial instruments actually take place, and it is not necessary that stock exchange should be in physical premise, a building or something like that. Earlier we used to have the stock exchange where physical premise, where the brokers or the members of stock exchange used to have something called open cry system, where they will be with certain signs and symbols and words, something like that. They exchange information between among themselves, and which indicate that this particular share is going to be sold by this particular broker at this particular price. Then somebody may indicate with a sign or something that is going to buy, that he or she is going to buy that particular at that particular price, or less than that or more than that. And in that case, that is a physical segment or a physical market there, but now actually the market has moved to digital or online format, where anybody who is having a connection to the internet, who can then, if he has a particular account like demat account and bank account, and also an account with the broker or the other service providers, who will facilitate the selling of the shares, like organized brokers are there, like ICICI Direct and all, have an account with them. In that case, what will happen, one can buy the share or buy and sell the shares in the market online. So, it is in virtual market now. It is need not be that you have to go to a particular premise. If you have an account, if you like to buy or sell the shares, you can do it sitting at home for that matter. And the brokers also have the terminals with them, and through them they can also transact, as though the investor need not go to the stock exchange physically to go for that. And we have prominent stock exchanges in India, like Bombay Stock Exchange and National Stock Exchange. They are prominent national stock exchanges, national level stock exchanges in India. There are also 19 other regional stock exchanges located in different parts of the country, typically in the capital cities and major industrial cities of the country, but they are actually almost non-existent. Their number of transactions that they have, volume of transactions, that is very negligible now, because all the shares are now available for sale or buy in the online format, the NSE and BSE. So, obviously, they have taken the major chunk of the market now. NSE of course now has a better percentage of share in the market in terms of volume that is there compared to BSE. There are some other international stock exchanges like NASDAQ and New York Stock Exchange in US, the London Stock Exchange or LSE in London or UK. Then you have Hong Kong Stock Exchange in Hong Kong. There are some examples of reputed international stock exchanges, and as we discussed, there are 4 national stock exchanges are there. There will be besides BSE and NSE, there is one more exchange called OTCI, or that is called Over the Counter Exchange of India. there is one more exchange called Interconnected Stock Exchange of India, which is connecting the regional stock exchange of India, but their volume dealt in that market is very negligible as well. So, prominent stock exchange in India is a BSE and NSE. Then we move on to the other terms in secondary market. Secondary market, as you discussed, it is no more physical delivery of the shares. Okay, it is like physical market is now online market. There is called Bolt is the online market of BSE. The BSE is online trading system. Then you have NEET, that is National Exchange for Automated Trading. So, Bolt system or NEET system in the respective stock exchanges. NEET is in NSE and Bolt is in case of BSE, and as we have discussed earlier. So, the shares can be transferred between one party and another party online for a particular price. So, one can give the price that I like to buy the share or I like to sell the shares of this particular company at this particular price, and there will be also corresponding buyer and seller, the quotes given by other players, other investors, and whenever there is a match between the buy quote of someone with the sell quote of some other person, and the trading can actually take place. And when the trading takes place, there can be two types of trading in stock exchange. That is, one is a cash account, another is a margin trading. In a cash account, though it need not be typically cash, that the cash is giving paid as such. In cash account, what happens, there will be delivery in a particular settlement cycle, or there may be non-delivery also. Delivery means the settlement cycle, like let us say T plus 2 is transaction plus 2 days, that is settlement period. So, within 2 days the settlement has to take place. That means, the buyer of the share will get the share and the seller of the share is going to get the cash as such. Then another is non-delivery based arrangement. In the same day, in the intraday, I take a position of buy and then I take a position of sell, and then the depending on the difference in market, I may have to pay or I may get some money from the market, depends upon the what I bought and what I sold and the settlement has taken place in that particular day. So, it is called, there is no delivery, rather I get the differential price as such, that is a cash account. There is also called margin trading. In margin trading, what happens, you need not have all the cash to be given by you if you are going to buy certain shares, neither you are going to give all the share that you like to sell for that matter. Based on a particular percentage of margin, one can go for a bigger volume of share transactions. It is like acting like a leverage, where you have a small amount to invest, but you can participate in the bigger size of the market or deal as such. So, based on that, so margin trading is based on that you have got small margin given and you can go bigger transaction there. Then in the case of market, there are different types of players in the market. They are called bulls, bears or stacks. Bulls are those investors or the brokers for that matter, who believe that the share price is going to go upwards. They are going to continuously going to rise. So, they are in a little optimistic that the share price is going to move up. Bear are those investors, those brokers, those participants who say that the share price is going to actually fall. They are pessimistic, expected the share price is going to fall. Stacks are some people who are not interested in this market as such. They are indifferent to whether it is there as a bullish market or bearish market, going up or market is coming down. Then coming to the again the certain other terms that you have is called in the BSE and NSE. There are different categories of shares. There is category in BSE you have got different categories, in NSE 2 categories are listed and permitted. In BSE you have got category A. Category A shares are supposed to be something like a blue chip, where there is more number of transactions that take place in this particular segment, and then they have got a huge bigger capital base, they have got a large shareholder. There is a big demand for this particular instruments for this company's shares. So, the category A, the best category in the category share, and there will be little lesser liquidity in those shares, but this other conditions taken care, they are called category B1, and category B2 is those also good shares, but they are not such good like A and B1, this is category B2. Then you have got category C shares, where there is a cash segment. So, everybody may not have the shares in the demat format, one may have the shares in physical format. There will be category C shares with the physical formats are actually there. And then you have category T, where there is because of certain manipulations or inside trading, this particular company may be under surveillance. So, those company shares are known as category T shares, and category Z shares are something which are not appealing to the investor. There are not lot of transactions happen, the companies do not furnish the required information in time, and that is the called category Z share. Then you have got category F share which is nothing but a category F instrument, that is called non-convertible debenture. Then you have got category G which takes care of something like central and state government securities like debt instruments. Then in national stock exchange you have got two category of shares, that is listed and permitted. Listed means that is they are listed in the national stock exchange, and permitted means it is listed in other stock exchanges, but permitted to be traded in national stock exchange. Then other thing that you have in secondary market is called the book closure and record dates. Certain information, certain announcements may be made like dividend declaration, bonus declaration, all these things can be made, and book closure means that till during that particular time, on that particular time the shares cannot be transferred to another person. Whoever is holding the share, he or she is going to get the benefit out of that particular information. The dividends will be going to those people who have the shares at that particular time. So, record date is there during the book closure takes place, so that the shareholder, the buyer or seller knows whether he is going to get the dividend or not. So, depending on that there will be a dividends ex dividend price or com dividend price. Ex dividend price means the buyer of the share will get the share, but not the dividend. Dividend will go to the seller of the share. There is something called block trading, where a bigger volume of transactions that take place, not small transactions, that is called block trading, typically between institutional players. There is something called penny stocks. Penny stock is that stock which is available for buying in the market for a very less price, and particularly typically those the book value of the particular share may be much lesser than the market. And other things that we have in the stock market, there is other very pertinent information about stock market is that there is a price earning ratio and price to book value ratio. Price earning ratio is nothing but market price per share to earnings per share. That is an indicator that which says yes, if the company's earnings per says x, P ratio is 9, the share will be set for 9x rupees. So, price to book value ratio is nothing but it is price per share divided by book value per share. These are indicators talk about whether this share lower the ratio is up for buying, higher the ratio is like up for selling. So, it is like overvalued. So, based on the industry, based on the comparison, one can have the price earning ratio to be high or price books is high or low for that matter. So, depending on the industry trend, one can say an average is let us say 9 and some price earning ratio another company is 10, so obviously it is overvalued. If it is 8 for the company, average is 9 for the industry, then it is actually undervalued. So, these are indicators, these are things which can help us decision making that whether can go for buying the share or go for selling the share. Then we have the barometer of the stock market, that is called stock indices, which act as a barometer of stock market and reflect the movement in the same. There are example of stock market index like BSE Sensex which comprises 30, which was set up in 1979, the BSE 200, S&P CNX Nifty are known popularly known as the Nifty, which is the base was 1995, and the Sensex and Nifty are broad based. There are sector specific indices, there are special indices like mid cap based company indexes, small cap company based indices, and these are based on something called free float market capitalization of the constituent stocks. Free float is that float that these particular shares are actually issued to the non-institutional investors, retail investors, not to the promoters for them. They are available for trading in the market. So, Sensex the base is 100 and Nifty the base is 1000 in 1995, Sensex base is 100 in 1979. One can see this particular chart which talks about the movement of Sensex, and if the blue line talks is the Nifty Sensex and the red line is Nifty, and it is from 2000 1st of 2000 to today's date is 17th March 2010, that has been given there the price how it has been actually moving. So, you can see there is a fall down, up and down, there is a up here peak there the 2007-8 around 8, then it has come down and again now it has come down. So, around 17,000-18,000 this is the price Sensex is moving, and something between around 5,000 Nifty is moving at this point of time. Then we have got another market called debt market. The debt market is the market where fixed income securities of various types and features are issued, and there is a market in the debt market. What is the instrument that traded? That is called instruments issued by central government and state government. instruments issued by municipal corporation, instruments issued by the government bodies, instruments issued by financial institutions in market, and public sector units, public limited companies. It also deals with something structured instruments like securitized based instruments. And what are the advantages of debt instrument is that there are investors can get fixed and periodic receipts of interest, capital is preserved for the investor, mostly the debentures are secured, can be risk free if it is issued by the government. It has a lower volatility compared to the equity instruments. There is a variety of instruments like index link, where the interest is linked to the particular index. It could be the consumer price index or wholesale price index, which protects the inflation for somebody. Floating rate notes, that means you get more interest at a more interest when you got upward trade in the market, you get low interest when there is a downward trade in the market. So, debt instruments are supposed to be substitute for the loan of the company. Debt instruments also can be traded in the market. There is a wholesale debt market segment in the stock exchanges, where the debt instruments can be traded, whether these instruments are issued by government of India or state government or the corporates. Instruments can be short term or long term. All debt instruments also liquid in the format, though there may not be retail investors participate much in case of debt instruments, but there is a lot of participation by the banks, financial institutions in the debt instrument trading. In fact, the debt market in size and volume is much bigger than the equity market, but it is not that prominent to the retail investors. But the market's mechanism is that it facilitates trading between the holder of the debt instruments to the so that it can go to the person who will like to, or institution like to buy this particular instrument, and debt market instruments give a lot of liquidity to the particular investor or the holder, and it is that is one of the reason, and also it takes care the risk and volatility. This particular debt market is much lower than the corporate other firm security like equity shares. Thank you.